G'day guys. So you may have noticed over the past few weeks that iron ore prices have plummeted down. But look at this. This is ridiculous. Look at these half price stocks. 30 cents down to 17 cents. That's almost half price. This stock is trading at half price. That's ridiculous. I am insulted. I am insulted by these prices. But they present a great buying opportunity. Okay, so let's check out GWR. Same thing. Like, look at that. 40 cents down to 22 cents. It's almost half price. Grange Resources. Basically 90 is up at 90 cents. Now down to, you can get it at 57 cents. Now that's a pretty good discount from its all-time high there, or not all-time high, but basically decade high or whatever. So first of all, I think, let's cover Strike Resources, because it's probably one of the highest potential out of these bunch. So Strike Resources market cap $45.9 million. If you look at Lithium Energy, which it owns 43% of Lithium Energy, so you've got a market cap on that of $52 million, which is higher than Strike Resources. So that accounts for about $22 million of Strike Resources' share price. Well, theoretically, hypothetically. What else can we see? Go back to my notes. Okay, so Strike Resources. I made a few notes so I could have a look at them so I could make this video. Okay. Oh, the net cash, $6.4 million. That's pretty good. The ownership of Lel, we've already covered that. Okay, so Lithium Energy, that's exploring in the lithium triangle, and it's adjacent to Orocobre. How do you say that? Orocobre. Anyway, so that's if you look at the market cap of Orocobre, that's above a couple of $1 billion, and Lithium Energy is on an adjacent tenement, so they're right next to the Sella de Olaroz. But if the sands deep sands underneath the Sella de Olaroz extend into the Solaroz tenements, then that could be absolutely huge discovery for Lithium Energy if they can confirm that. And you've got a massive upside there, which would obviously pass on some value to Strike Resources, being the major shareholder in LEL. But you can't always make assumptions like that. Like the science behind it looks like there's a possibility these brines could extend onto the Solaroz tenement. However, we don't know until they've gone and drilled it, I suppose. They got a good backup project, which is the Burt Graphite project. Graphite's going to be in pretty good demand for this decade, you would expect, with the lithium battery, the whole EV thing. So next of all, we've got a Purimac. So that's in Peru. That's one of Strike's assets, and they're already producing. So they've just shipped 35,000 tons of 65% Fe lump, with an estimated free on board cost of $80 USD. So this lump, if we look at the price indexes, there's also the premium for the 65% for a start, which is lately that's been something like $20 per ton, and you've got your lump premium, which has come down a lot. It's basically slid, but it was let's say 20 cents lump premium there. So you're looking at quite a decent premium on this product. It could be selling at today's rate of $190 US. So there's a great margin in this Ari Purimac lump ore, being a premium product, and it's being produced at a decent cost relative to the pricing at the moment and the premium. So they could get a $3.5 million profit margin just off that shipment alone. And that's income that's going to be coming in probably starting in the next quarterly report, and that they plan to accelerate that to 250 tons per annum, which at 150 dollars per ton US, you're looking at a 25 million plus dollar profit per annum. Even if you drop down to like $100 per ton, I'd hope that we don't drop below that anytime soon. You're still getting you could be looking at 10 million per annum from that until it drops off even further. Long-term potential for Purimac, they're updating their feasibility study. The government's planning to build a rail by 2028. That would be very beneficial because then they can use lumps and fines, which is, they can produce those at, they estimated something like $11 per ton. So, the other option is the 15 to 20 million ton slurry pipeline, which is over a 3,500 meter decline, which is going to be like probably one of the cheapest options for transport. Diesel prices, fuel oil prices skyrocketing. If you're sending your ore down a pipeline with a 3,500 meter gradient, that's going to be pretty cheap transport for that slurry. Obviously lump products are more higher premium than the slurry, but it is a 68% slurry, which is a premium product, and it's going to demand a premium price. And they can still produce that at less than $20 per ton, according to their old outdated feasibility study, which is being updated, so that's good. And this is where it gets ridiculous. Is that grade of Purimac is 50 to 60 versus your typical 14 to 30%. Iron Bridge is something, FMG's Iron Bridge is something like 30%. And these guys are coarse grain, so there's low grinding, so you don't have to worry about that grinding input. You got a 260 million ton resource. I would expect this to be something to be like a 1 billion plus, net present value on that asset if they can bring it into full production. But at least they're still getting some money out of a 250 thousand ton per annum direct shipping oil. With a capex though of the $2.2 to $3 billion, potentially going to be difficult for them to develop unless iron ore demand continues to be quite high. Like if the seaborne iron is in a deficit and a lot of financiers come online to potentially fund this project, then it could potentially go ahead, but perhaps don't count on it. I mean, they've had it for over 10 years and didn't develop it, so that could be a lot due to the crash in the iron ore price down to 2015, and now potentially could go up again and then come back down again. If they got it developed, that'd be great, is the point. But what they do have though going for them at the moment is Paulsens East with FID, so your final investment decision is imminent. Possible start in 2022 with $140 million pre-tax NPV. However, you got the $25 million forward tax losses, so then you take it to $123 million NPV versus their $45 million market cap. Is still pretty attractive if they can bring this on within the next year and bring it into production. You could see, obviously 100% upside in the share price relatively quickly, obviously dependent on the iron ore prices. But their feasibility study, if you do read it, you've got a life of mine average price of $100. They're basing it on $100 per ton over the LOM, and that's the 62% benchmarks fines. However, they're producing 3/4 lump and 1/4 fines, so that's a good ratio because you're going to get a lump premium. They've estimated 20 cents recently it has been going higher than that, as you would have seen, up to 50 cents, especially with decarbonisation and restrictions on emissions. You will see that premium on the lump product. Okay, so you got the low 64.8 USD, free on board cost per tonne, and a low capex of $15 million. So my summary on this one was the low market cap barely assigns any value for Strike's assets. You got significant upside potential, at least 2 times in the next 6 months or something if they develop Paulsens East. And obviously, if Lithium Energy finds something, that's your gamble play, I guess. And that would be enormous, billions dollar value asset. And you've got your if a Purimac was fully developed, I guess that's your other gamble, because then obviously you could have like a 20 to even 100 times upside, depending on what the iron ore price is going to do over the next few years. That's hard to say. Next one, I guess Grange, GRR. They're $650 to $700 million market cap at the moment with these prices. Trading come dividend. Although it's quite a small dividend, they haven't increased their payout, but they are sitting on $400 million of cash, basically. And they also have a lot of other assets, and that's not even including the recent July, August, September quarter, where they're still probably making quite a lot of money. They made $200 million or something like that in the last quarter. If you read there, it was the last quarter or last half. I think even quarter. They made $200 million. So that is a significant profit margin there, and there's not much difference there between the market cap and their cash assets, and especially if you take into consideration their forward earnings, they're still going to be really high. I mean, you can backdate the earnings reports and have a look through them, and you can see they were still profitable even at much lower prices than the current iron ore price. As long as the iron ore price doesn't drop tomorrow down to, say, $50 a tonne, where they'd probably break even perhaps, or still even make money, given that they're selling premium pellets to the market. They're certainly probably going to be making up their entire market cap, in cash profits post-tax, before, even if the iron ore price went down. So, how does that make sense? This seems like quite a safe bet in that regard, because your entire asset equity is going to be backed by cash and income production from their iron ore mine and pellet sintering plant. So, that's good value there on Grange. Especially if they develop their some other assets that they have in their development pipeline. They need equity to do that. I mean, they need a lot of capital to do that, but perhaps that's why they're not paying out, a high dividend yield. Whereas if you look at Phoenix, which is looking at a 50 to 80% dividend payout, they also have $49 million cash at the moment, post-tax. So they can pay out 50 to 80% of that in the next dividend, trading at something like $140 million market cap. So if we take that in consideration, they could have a 20-30% even yield on their upcoming maiden dividend. Potentially, we'll see what happens. But Phoenix Resources, they've locked in a swap agreement. So basically, that's a derivative, but they will be essentially locking in a price of 230 Australian dollars per tonne for 45% as basically, so 50,000 tonnes per month, which is approximately 45% of their going forward production, and that begins in October and runs for a year. So they're locking in something like $50 million profit at least, for the next year, at which then they will move on to mining a higher grade. So $50 million net cash, and locked in $50 million profit. Probably also going to receive quite a good earnings from this quarter as well. And surely if the iron ore price doesn't just drop drastically another 50%, they'll keep making good profits throughout the next year. And if we go to, what was it, GWR, yeah, that dropped down almost half price. Yeah, I can't really say as much about them. Obviously have a lot of potential with 100 million tonne resource, which is huge relative to, say East Paulsens or Phoenix Resources. What are we talking, like 8 to 10 million tonnes, or Tombador iron. So it's a larger resource, but they haven't locked in swap contracts or anything like Phoenix, and they haven't got as much cash on hand. But they do have, with a $60 million market cap, $23 million of cash reserves, $23 million of cash reserves. What else do they have? About $10 million in equities in ASX listed stocks, mainly tungsten mining. And yeah, so the next quarter should be a decent earnings as well. Also moving to a ramping up production quite extensively, and moving to a stage 2 pit with an 82% profit sharing with, who was it, Pilbara Resources Group, or whoever their mining contractor is that they're partnered up with. So yeah, basically there's quite a few of these iron ore stocks that are trading at a heavily discounted price to, I guess, their cash and their earnings potential. These might just be short-term instances where they might remain profitable, but they probably will cover their market caps relatively quickly, in which basically, if your investment is 100% backed by cash, there shouldn't theoretically be any downside risk if they pay it out. So anyway, that was my summary of these couple of stocks.